Welcome back, everyone. It is Michael here with Offshore Citizen, and today we're going to cover a really quick topic, which is what is a C-Corp? All right, so I've done some videos in the past on the subject of different corporate types, and I'm going to dive specifically into this one today, in part because of the fact that, I think some people are just looking for a little more specific information, a little more contextual information. A C-Corp is a specifically U.S. entity, okay? So it is a type of legal entity, a company, within the U.S. So it's a term that you're not going to hear anywhere else in the world, and that's because the U.S. has C-Corps, they have S-Corps, they have B-Corps, etc. Okay? Now, a C-Corp is what you would commonly refer to, it's like the most normal type of company that people are used to seeing around the world, all right? It is essentially a limited company in UK or in Canada or in wherever, right? These types, it's just a normal limited company, meaning that it's limited by shares. So there is liability protection for the shareholders in that their liability is limited to what they've invested in the company, theoretically. It has the protection of the corporate veil. So notably, it has shareholders, right? And those shareholders are typically going to have some sort of a shareholder agreement between them. Now, you could have a single owner of a C-Corp, all right? This is the most common structure for a big company, okay? A big company would most commonly be structured as a C-Corp. Now, that doesn't mean that you as a small business should. In fact, probably you shouldn't. If you're in the US, if you're American, you should probably have an S-Corp, not necessarily, but quite possibly. And if you're a foreigner, you should probably have an LLC, although again, not necessarily. There are some tax treaty rules that may be relevant to you. So for instance, on certain types of investing, if you're, say, a Canadian investing into the US, it may be beneficial to use a C-Corp. Okay, so a C-Corp can be owned by foreigners, it can be owned by people domestically, etc. No problems there, right? You form it and you can have one to, in theory, unlimited number of shareholders. Okay, you can decide to have multiple share classes, no big deal. I'll maybe do a video on share classes in the future and how that all works. And you may be in a situation where you can have, like different rights for those different share classes. Okay, you can govern it you'll typically, in theory, well, you'll have directors. Okay, so the structure is you'll have a legal entity, the legal entity will have shareholders, and there'll be directors. Okay, that's what the structure is. Now, again, in practice, you may be the only director, you may be the only shareholder, there may be multiple directors and a single shareholder, or there may be multiple shareholders and a single director, okay? There are some rules around how this gets maintained, but the bottom line is this is pretty much your basic company. Why people choose to go with some of the others is because of tax reasons. So a C-Corp is taxed as a separate entity, so whatever profit that company earns, it gets taxed on that profit, and then it distributes the dividends from it to the shareholders, okay? That's where there are some consequences, because if a US C-Corp is owned by foreigners and it pays out a dividend, there's probably going to be dividend withholding tax, okay? So in addition to, okay, there's US tax payable, then there's going to be US dividend withholding tax, then there'll be the tax consequences wherever the shareholders are resident, okay? So that's important to note. If you're a local American, then you'll get preferential treatment as probably as what are called qualified dividends, meaning that they're taxed at lower rates, basically the capital gain rates, as opposed to regular income rates. And the reason for this is because it offsets the tax that's already been paid. So if you just consider, if I'm the owner of a company, say I'm the only person just for simplicity's sake, and I can pay myself a wage, right? So the company makes money, it has its operations, etc. At the end of the year, or periodically throughout the year, I could be paying myself a wage, and that would be an expense for the company. So it would reduce the taxable income, and therefore they're not going to have to pay corporate taxes on that. Now, if I decide not to do that, I say I leave the money in the company, then the company is going to pay tax on that profit, and then when I pay it out, if you just add up that corporate tax, plus if it was full personal tax, you'd basically be double taxed. So what they say is, okay, we're going to give you a favorable tax rate on the payment of these dividends, okay? And that should approximately add up to what you would have paid if you had simply paid yourself a wage. It's not exactly, but in theory, it's approximately in that range. And there's some consequences of this to you in that you can take advantage of some deferral in that company, okay? So you can essentially defer the money inside the company and you can reinvest and you can grow it potentially at a lower tax rate than if you paid it out personally. And that can then mean that in the end, when you pay it out, you get a benefit, okay? So let's look at how this would work. Well, let's say that my personal tax rate is, let's just use the figure 40%, okay? Say it's gonna be 40%. And the company is gonna pay taxes of 21%, okay, the federal rate, so let's just assume there's no state tax in this particular example. And I'm gonna wanna invest later on, okay? So the company makes a bunch of profit, let's say it makes $1 million, okay? The company makes $1 million. If I was to take the money out, I would pay my 40% tax on it. I'm kind of oversimplifying here, but let's just assume for the sake of easy numbers, right? 40% tax, now I have $600,000 left to go and invest with, okay? On the flip side, if I was to leave the company, the money in the company pays 21% tax. So I've got $790,000 left to reinvest. So I have a larger amount and I can go, and this will compound, right? As that asset grows, then all of a sudden you can end up earning more. Now there's, again, I'm oversimplifying the rules here, but I'm giving an example of potentially how this can play out and have an advantage, okay? So anyway, it's quite simple to form. Every state has C-Corps. You can form them fairly quickly, fairly inexpensively. It's not a particularly big deal. Like I said, for a small business, unless you're gonna have a bunch of shareholders, most of the time, the maintenance process and the rules around what we call corporate governance are easier in an LLC. And there's, because the tax treatment is different in terms of the flow through, et cetera, usually you would not want to have it. However, that being said, there are some cases. Then if you have questions, if you're wondering, hey, is it right for me, right? Maybe I'm gonna have partners, I'm gonna have multiple shareholders, maybe some people are outside of the country, maybe they're inside the country, whatever, contact us. You can write in the comments, you can email us. If you go to www.offshorecitizen.net, www.offshorecapitalist.com, either of those websites, you can get in touch with us. We're happy to help you. Also, you should like and subscribe to these videos. I have a bunch of other videos where I go through explaining some of the more detailed nuances, like what is withholding tax, how does that work, what are the different corporate forms, contrasting them a little bit more. So anyway, I hope that's helpful to you, and I will look forward to seeing you guys on the next video.